Honestly, everyone was low-key scared going into this earnings season. West Asia heating up, crude rising, and nervous markets. So we did what we always do. We sat down and went through the numbers. 265 companies one by one. And you know what? It was actually a great quarter. Median profit growth of 20.67%, and when profits grow faster than revenues, that's not luck. That's companies becoming genuinely more efficient. That's the signal that matters. But we didn't stop at the headline. We filtered more, market cap above 10,000 crore. Basically, we only kept the ones where the business itself actually got better. Better margins, better operations, and real stuff. And only 5 companies make the cut. Hi, I'm Aparna, and in today's video, we will be breaking down these 5 stocks that gave strong quarterly results and have strong fundamentals too. So let's start with the stock that surprised the most, Paytm. Now look, for the longest time, the Paytm story was not a fun one. Big losses, burning cash, regulatory issues, a stock that fell badly after its IPO. Most investors had either lost money on it or just stopped paying attention. But this quarter, something actually changed. Revenue grew 18.4% to 2,264 crore and PAT came in at 183 crore positive. Now compare that to a 540 crore loss in the same quarter last year. And here's the thing. FY26 became Paytm's first ever profitable year as a listed company. Full year profit of 552 crore. EBITDA also turned positive at 132 crore. Now, is this real or is it some accounting adjustment? And that's exactly what we checked. This was real and it came from the core business actually performing better. Let me break it down. Merchant GMV, basically the total value of payments processed through Paytm, grew 27% to 6.5 lakh crore. In simple terms, more businesses using Paytm and they are processing bigger volumes. The subscription merchant base also crossed 1.51 crore. These are merchants paying Paytm regularly for sound boxes, QR codes and payment tools. But here's the part most people missed. Payment margins improved from above 3 basis points last year to above 4 basis points this quarter. Now I know 1 basis point sounds like nothing, but when you're processing lakhs of crores in transactions every quarter, even that adds up to a lot of money. And this happened because Paytm is deliberately pushing users towards higher margin products. Credit cards on UPI, EMI payments and Paytm Postpaid. Postpaid is basically a small ticket buy now pay later product. Pay now, settle later. And strategically, these users are gold. They transact more often, they engage more deeply, and they are much easier to cross-sell financial products to. The financial service business is the second engine. This includes merchant loans, consumer loans, wealth products, and broking. This segment's revenue grew 38% in Q4 to 750 crore rupees. Now, what makes the model really smart is that Paytm doesn't lend its own money. Banks and NBFCs give the loan. Paytm just runs the platform. It finds the customers, uses payment data to assess risk, handles collections, keeps users engaged. It earns the fees without putting its own capital at risk. That's what makes it asset light and scalable. But yes, there are risks too. The first one is regulatory dependence. Government incentives linked to UPI infrastructure called PIDF are reducing. So future profitability increasingly depends on Paytm monetizing users on its own without that safety net. And the Paytm payments bank license cancellation by RBI is still a lingering concern. The core app works fine through partner banks, but the trust question with regulators hasn't fully gone away. Second is competition. PhonePe, Google Pay, banks, everyone is fighting for the same pie. Holding these margins in that environment isn't easy. Alright, now let's move on to stock number 2, which is Sterlite Technologies. Sterlite makes optical fiber cables and digital network solutions, basically the physical infrastructure that carries data. For the last 2 years, this business was struggling. Telecom companies globally had cut their spending. The optical fiber market was in inventory correction mode. But something has shifted. Data centers started expanding rapidly, partly because of AI, which needs enormous amounts of computing and connectivity infrastructure. Data traffic globally kept growing. Telecom operators started upgrading their fiber networks again, and all of that demand landed right in Sterlite's order book. Now let's look at the numbers. Q4 revenue came in at 1,441 crore, which is up 37% year on year. EBITDA went from 59 crore last year to 218 crore this quarter. Margins expanded to 15.1% and PAT from 5 crore last year to 59 crore this quarter. Now, this wasn't just market timing working in their favor. Sterlite made some smart moves. They won large data center contracts in North America, signed a long-term deal with a tier 1 Indian telecom operator, and diversified their order book so they are not over-dependent on any single client or region. More importantly, they are shifting their business mix, moving away from selling commodity fiber where margins are thin toward integrated digital network solutions where margins are structurally better. Management is also pointing to AI infrastructure build out, hyperscaler demand, and broadband expansion as multi year tailwinds. These aren't short term themes, but yes, there are risks. Raw material costs are rising, West Asia tensions are pushing up prices of helium and polymer based compounds, both of which are critical inputs in optical fiber manufacturing. So, even as revenues grow, input cost pressure could weigh on margins. Now let's move on to company number 3, which is Wockhardt. Okay, now this one has a longer backstory, so let me give you the quick version. Wockhardt is a pharma and biotech company. For years it struggled, US FDA issues, high debt, a legacy generic business under pressure. The market largely moved on, but Q4 FY26 gave people a reason to look again. Let me tell you this through the numbers. Revenue grew 30% to 965 crore. EBITDA jumped from 79 crore to 196 crore. Margins expanded to 20% and PAT of 164 crores versus a 45 crore loss in the same quarter last year. So what actually changed? Two things, and both are genuinely interesting. Driver 1 was biosimilars. Now, most people know what generic medicines are. They are basically chemically identical copies of branded drugs which are sold cheaper. Simple. Biosimilars are different. They are copies of biological medicines, medicines made from living cells, not chemical synthesis. And because biological processes are far more complex, developing a biosimilar requires more money, more time, and clears a much higher regulatory bar. That complexity is actually a competitive advantage. Once you are in, it's hard for others to follow. Wockhardt's biotech revenue grew 126% in Q4 to 252 crore. Full year biotech hit 697 crore. Most of this came from their insulin and biosimilar portfolio in emerging markets. Growing markets, rising demand, better margins. And the impact on overall margins was sharp. EBITDA margins went from 10.7% last year to 20.3% this quarter. That kind of improvement tells you higher margin products are now a much bigger share of this business. Driver 2 was novel antibiotics. This is the longer term bet and it's fascinating. Wockhardt has been quietly building an antibiotic pipeline for over a decade, specifically targeting drug resistant bacteria. MROC and MROC O are their lead products designed to treat MRSA infections. Now, MRSA is basically a dangerous superbug that has evolved to resist most common antibiotics. It causes serious hospital acquired infections and is a growing global health crisis. There are very few effective treatments. Wockhardt is trying to be one of them. MROC revenue grew 106% in Q4. Management believes these products are on track to become leading brands in the anti-MRSA segment globally. But yes, there are risks. The biggest one is execution. Regulatory approvals, commercial rollout, real world adoption, all uncertain. Clinical success doesn't automatically become commercial success. Geographic exposure is also a concern. Heavy dependence on the UK and emerging markets means currency swings and tender based pricing can affect margins significantly. Now let's move on to stock number 4, which is CreditAccess Grameen. If there is one sector that investors had almost completely given up on over the last year, it was microfinance. Borrower stress, over leveraging, repayment problems, state level disruptions. The whole sector was under pressure. And CreditAccess Grameen, which is India's largest microfinance NBFC, was right in the middle of it. So when Q4 numbers came out, a lot of people were genuinely surprised. PAT came in at 340 crore rupees, up 619% year on year. Revenue grew 13.5% to 1,597 crore, and AUM, which is the total loans outstanding, grew 14% to 29,590 crore. 619% profit growth sounds almost too good to be true. So let me explain what's actually happening. Think of it like this. When times are tough, when people aren't repaying loans on time, a lending company has to set aside extra money, like keeping cash locked up just in case things go wrong. That locked up money doesn't show up as profit. So profits look terrible. But when things start improving, when people start repaying, when fewer loans are going bad, that locked up money gets released. And suddenly profits jump fast. That's exactly what happened at CreditAccess this quarter. Borrowers started repaying more reliably, fresh bad loans declined sharply, and the money that was locked up as a safety cushion, it came back into profits. That's the real story behind the profit jump, not magic, just a sector healing faster than anyone expected. At the same time, loan disbursements grew 28% to 8,313 crore. The company added nearly 10 lakh new borrowers during FY26. Rural credit demand held up better than the market expected. The franchisee is still very much intact. Now, here's what's interesting for the longer term. CreditAccess isn't just doubling down on microfinance, they are actively building a secured lending book, home loans, MSME lending. There are even potential acquisition opportunities being evaluated in the mortgage segment. The idea is simple: secured lending carries lower credit risk and makes the business more stable over cycles. Microfinance alone is too exposed to sector level stress events. Management guided for 20 to 25% AUM growth and 16 to 20% ROE for FY27. Those are confident numbers from a sector that was being written off just a few quarters ago. But yes, there are risks too. Karnataka accounts for 23% of CreditAccess Grameen's borrower base. That's a big single state concentration. Any political intervention, regulatory disruption, or localized repayment stress in Karnataka can have an outsized impact on the whole business. Now let's move on to the last stock on our list, which is Lloyds Metals and Energy. And this one might be the most dramatic story of the five. Lloyds operates iron ore mining out of Surjagarh in Maharashtra. And Q4 FY26 was a textbook example of what happens when a commodity business hits its operating leverage moment. Capacity ramping up, product mix improving, and fixed costs already covered, all at the same time. Let's look at the numbers. Q4 revenue came in at 4,977 crore, up 310% year on year. EBITDA came in at 1,679 crore, up 498%. EBITDA margins 33.73% versus 23.15% last year. And for the full year FY26, total income of 13,838 crore, growing 104% year on year. EBITDA of 4,673 crore with margins of 33.77%. Now, 34% EBITDA margins in a metals and mining business, that's genuinely exceptional. Let me explain why. Mining businesses carry huge fixed costs: machinery, logistics, beneficiation plants, mining operations. When volumes are low, these costs eat into margins badly. But once you cross a certain utilization level, something interesting happens. Additional revenue starts flowing through at very high margins because the fixed costs are already paid for. That's operating leverage. And Lloyds crossed that threshold in a big way this quarter. They've also been deliberately shifting towards higher grade ore and value added products, especially pellets. Pellets are processed iron ore. They command better pricing and better margins than raw ore exports. Lloyd scaled pellet production from 3 million tons in FY26 towards a target of 8 million tons. That shift in mix compounds the margin story significantly. But here's where it gets really interesting for forward looking investors. Lloyd is not positioning itself as just an iron ore company anymore. Through Surya Mines, they are scaling copper production from 10,000 tons currently toward a long-term target of 1 lakh tons per annum over the next 3 to 5 years. And then the Chemaf acquisition gives them exposure to cobalt and rare earth minerals, materials that are critical for EV batteries and the global energy transition. That's a completely different story from a simple iron ore miner. Also, you should know that Lloyds holds its international copper assets through Nexus Holdco, where its wholly owned subsidiary, Lloyds Global Resources, owns a 50% stake. Nexus Holdco itself owns around 80 to 90% of Surya Mines. Worth understanding the structure before investing. But yes, there are risks too. Surya Mines operates in the Democratic Republic of Congo, and right now, sulfuric acid shortages and geopolitical uncertainty are already impacting copper production volumes there. Operating in the DRC is a very different risk profile from operating in Maharashtra. Back home, mining leases, environmental clearances, land acquisition, transportation approvals, these are always overhangs in the mining businesses. Any policy change around royalties or export duties can also hit margins quickly. And one more thing, when commodity margins are high, everyone rushes to add capacity. If supply growth gets excessive across the industry, pricing power weakens. That's the cyclical risk that comes with every commodity upcycle. So let's bring all of it together. 5 companies, 5 completely different sectors, and 5 different stories. But here's the one thing that was common across all 5. It wasn't just that the profits grew, it's that the quality of those profits improved. Margins expanded, balance sheets got stronger, and management across all 5 companies sounded genuinely confident, not just optimistic about FY27. And that combination is exactly what tends to create sustained re-rating in stocks, not just a one quarter bounce. Now, this is still only the middle of earnings season. As of May 13th, nearly 1,000 companies have declared results. We've barely scratched the surface. Now, if you want us to go much deeper into which sectors delivered the strongest growth, where margins expanded the most, and which companies genuinely surprised the most, comment earnings and we will get at work. And if this breakdown was useful, share it with your investor friends. That's honestly the best support you can give this channel. See you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.